Of the nearly 900 stocks in the consumer staples sector, which are your best investments for the dividends and protection from whatever the stock market brings? I'm screening through all 900 companies to reveal the 5 best consumer defensive stocks for your money. I'll not only walk you through how to find these stocks, but show you 2 ETFs you can use to get instant diversification. We're talking consumer staple stocks today on Let's Talk Money. Beat debt, make money, make your money work, creating the financial future you deserve. Let's Talk Money. Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. A special shout out to everyone in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, I am loving our stock sector series, and more than 40,000 of you have tuned in to see the best stock picks from each sector of the economy. We're 5 videos into the series, and this could be one of my favorites for investing over the next year. Now, we've talked about the state of the economy in other videos, how this 10-year bull market is wobbling on the edge, and some factors that I'm watching that could mean tough times for investors within the next year. But you can't just sit out this market. Trying to time that next stock market crash is like trying to drive over a bridge before it's finished. Sometimes being too early is just as bad as being too late. Fortunately, consumer staple stocks are some of the best long-term, high-dividend stocks you can buy that are not only going to give you the opportunity to stay in this market making money, but also protect your portfolio if the market does crash. If you look at the Consumer Staples Fund, this green line here, against the broader market leading into that 2009 stock market crash, consumer staple stocks dropped less than half of what we saw in that S&P 500 over the period. In this video, we'll start by showing you why consumer staple stocks are able to benefit from that stronger market as well as protect you from a crash. I'll show you how, as an equity analyst for private wealth, I used to pick these high-yield stocks for clients. Then I'm going to reveal 2 consumer staples ETFs and 5 of the best consumer staples stocks that should be on your radar for 2020. Now, if you're just joining us, we're doing 11 videos to reveal the best stocks to buy in each sector of the economy. I'm looking at each sector from tech to energy, consumer goods, and utilities to show you how to find the best of breed companies in each and create that diversified portfolio for growth and cash flow. Now, this is hugely important because even though I love these dividends and these defensive stocks, you have absolutely got to have investments in those other sectors. It's going to give you that diversification you need to grow your portfolio no matter what the economy brings. So if you're coming in later to the series, I'll link in the first comment below the video to the most recent video. I'll also be linking in the video description all the videos in the series so you can see all the stocks in each sector. Here we see the 11 sectors of the economy, and remember, each sector is made up of different industries that work in the same product or the same service category. And today we're talking about those products you buy no matter what the economy does. The food, the household and personal products, the beverages, and yeah, even maybe some of those adult beverages. We see here that over the last 5 years, the consumer staples sector has lagged the rest of the market pretty badly, returning just 27% against that return of 51% on the S&P 500. Over the last year, the sector has only returned 6.8% versus an 11% gain on the market. In fact, only the energy and the healthcare sector have done worse for returns. But there's good reason to believe the staples might just turn this around in 2020 and why you need these in your portfolio. You see, because consumer staple stocks pay out such huge dividends, they behave a lot like bonds when it comes to interest rate changes in the economy. When interest rates decrease, investors start looking for those higher yields in bonds and stocks in this sector, and the prices go up. When rates increase, investors get higher yields in other investments, so they abandon these staples and the prices drop. And that's what happened to consumer staples over the last few years. You see here in a chart of the consumer staples sector ETF and the S&P 500 pretty much tracking each other perfectly from 2009 to late 2015. Sure enough though, when the Fed started raising rates in December 2015, the pain started for these dividend stocks. The market started outperforming and consumer staples flatlined. But we're seeing the opposite of this play out right now with the Fed cutting interest rates 3 times since July 2019. Investors are again searching for those high-yield dividend plays and could come back to consumer staples in a big way. So before I highlight those 2 funds and the 5 stock picks in the sector, I want to show you 2 factors that you can use to pick stocks on your own. Everyone in the nation knows I'm not about just lay down 5 stock picks because that does nothing for you. Do not just come on YouTube or tune in to CNBC to get your stock picks. Understand how you find these and use that power to have that control over your money. Do not give someone on TV control of your investments. Now, these two factors are above and beyond the fundamentals that we talked about in that first video of the series. I'm using trends in revenue, operating margin, and catalysts to pick the stocks in the sector series, but these next two are extra ones that you'll absolutely want to be watching for when you pick these consumer staple stocks. If you're just joining us, make sure you find that link in the video description below and watch that first video to see how we're picking these stocks in this video series. But the first factor here for consumer staple stocks is going to be that payout ratio. The payout ratio is the single most important factor for making sure that dividend on the stock is going to keep paying out. This measure is the percentage of a company's profits or its net income going to pay that dividend. Now, the payout ratio is important for a couple of reasons here. First, because a company stretching to pay that dividend, pushing all the profits out the door to cover it, probably isn't going to be paying the dividend for much longer. If a company is paying out 65 or 75% of its profits to the dividend, it doesn't take much of a hiccup in profits until they have to cut those payouts. Also, though, a company paying out much more of its profits to investors probably isn't saving enough back for growth versus its other competitors. That's going to mean missed opportunities and lost market share and eventually falling profits. So what I'm doing when I'm looking at consumer staple stocks is comparing the payout ratio across different companies. Now, there's no right or wrong answer here, but you're trying to find companies that already offer a solid dividend yield, a solid dividend, but are maybe paying less of their profits out for that dividend. So companies that can afford to increase the dividend payment. Finding the payout ratio just means taking the annual dividend amount per share and then dividing that by the earnings per share. Now, the next factor here before we get to those 2 funds and 5 stock picks is making sure that the company has a quality balance sheet. This one takes a little bit more digging, but with rock bottom interest rates, companies have just been on a buying binge for more than a decade. They've been borrowing to buy back stocks. They've been borrowing to make big, expensive acquisitions, and it's led to a massive mountain of debt. In fact, it was this massive debt that killed Kraft Heinz after its 2015 IPO from private equity. One of Buffett's top picks that year is now trading for less than half its price because that debt took away that financial flexibility to stay competitive. So what you want to look for here is going to be measures like debt to equity and then how much of earnings are going to make those interest payments. Again, just like the payout ratio, it's not so much the absolute level of debt or the measures here itself, but how they compare against other companies. You want to be investing in companies with relatively low measures of debt compared to their competitors. Now, just like the other videos here, we're going to start off with a couple of consumer staples ETFs before we get to those 5 stock picks. These funds are going to be a great way to get that sector exposure if you can't find individual stocks that you like, or maybe if you just want a little bit more diversification. Our first here is going to be the Consumer Staples Select Sector Spider, ticker XLP, with a 2.6% dividend yield and an expense ratio of just 0.13% annually. The XLP holds shares of 33 companies in the sector and based in the United States and has returned a 12% annual return over the last decade. You can see here it's pretty well diversified across the industries in the sector, from beverages to food and household. For the other fund, I wanted to show you an international option, so we have here the iShares Global Consumer Staples ETF, or ticker KXI. Now, like a lot of smaller funds, the expense ratio is higher on this one at 0.46%, but the dividend is solid, and this one is going to give you that broad exposure to the global consumer. Half of the fund is still invested in US companies, but you've also got exposure to Europe, Australia, and Asia here. Here you can see that the KXI and that larger XLP fund have tracked each other pretty closely, but there is some opportunity here when the two move out of step, maybe positioning in one of the cheaper shares for that bounce back. Now I want to reveal 5 consumer staple stocks that I found that should be on every investor's radar. I've got some bellwethers here, those popular brands that everybody loves, as well as a few surprises. I've ranked them here by dividend yield, so we'll be counting down to the highest dividends in this sector. Now, PepsiCo, ticker PEP, is our first pick here, and its 2.9% dividend puts it on the bottom of the list, but the total return on the shares makes this a solid investment. Shares have produced an 11.5% annual return over the last decade, above the 10% annual return on shares of Coca-Cola. And I got to tell you, I like the taste of Coca-Cola better, but the fundamentals on Pepsi go down a whole lot easier. Between the two, they control over 70% of the non-alcoholic beverage market, which gives them both massive pricing and distribution power. Pepsi's annual sales are almost exactly twice that of Coca-Cola, though, and its payout ratio leaves a lot more room for growth. Pepsi pays out just 68% of its earnings to cover that dividend versus Coca-Cola, which needs 78% of its earnings to cover its dividend payment. Shares of Pepsi don't come cheap, though, something that you're going to see in a lot of these stocks in this sector, and it's trading for a price of 24 times earnings. Profits are expected about 4% higher the next year, so I would put them closer to 6% higher, given the management's history of beating these expectations. We see a broad band of price targets here from the 11 analysts covering Pepsi, with a low target of $115 and a high target around $155 per share. Now, despite the lackluster targets, this is one that you can put in your portfolio and forget about, and you'll always know it's going to produce. Next here is Kimberly-Clark, ticker KMB, the $45 billion personal care products giant, paying a 3.1% dividend yield. Now, what I've tried to do here, as we've seen in those other videos in the series, is to pick some of the best stocks across different industries in the sector. So here with KMB, you've got personal care products. We had beverages and snacks with Pepsi, and we'll see some of those other industries in our next few picks. What I really like about Kimberly-Clark, though, besides the fact that it's only paying about 61% of its profits to cover that dividend, which leaves a lot of room for growth, what I love here is that the company has been reinvesting an average of $5 billion annually over the last 5 years into product development and marketing. Now, you don't see that level of reinvestment at its competitors, so what I think could happen in the coming years is that KMB reaps those benefits with faster revenue growth and cash flow. Now, shares trade for 19.6 times earnings, which are expected 5.8% higher over the next year, but I think those surprise revenues start to play out here. Analysts have a low target of $123 per share here and a high of $155 each for the stock over the next year. I like it at least up to that $150 per share range for a long-term bet. Now, this next one is going to be one of the big surprises here. Kraft Heinz, ticker KHC, and its 4.9% dividend yield. Now, I've warned investors against Kraft Heinz since starting this channel, and yes, even used it as the poster child for a bad balance sheet earlier in this video. But I'm calling it. Shares are down 60% since the 2005 listing, and there's a lot to like going forward on this stock. Kraft cut its dividend late last year, which absolutely destroyed the shares, but now it's paying just 54% of its earnings to cover the payment. That's supporting cash flow, helping to pay down some of that debt and stay competitive in this market. Now, the company has $2.3 billion in balance sheet cash, is the third largest food and beverage manufacturer in North America. And let's not forget that Buffett's Berkshire Hathaway still owns almost $11 billion in share. That's more than 25% of the company. And you better believe he's pushing for those profits. Shares of Kraft trade for just 11.2 times earnings, making it one of the cheapest consumer staple stocks you're going to find. Earnings are expected to be down 13% over the next year, but margin gains reported over that last quarter make me think they could beat on this number. This is a stock that analysts have all but given up on, and a low target of $23 a share and a high of just $34 each, right around where it's trading at now. Now, I don't want you to think that this is going to be a magical ride higher either, though. Investor sentiment is still negative on this stock, but there's a lot of value here for investors willing to take a shot and hold on for the long term. Big Lots, ticker BIG, is another risky one here, but paying a solid 5.6% dividend and some really good fundamentals. Big Lots is kind of an iffy one. It's technically in the retail sector, but sells so much into that consumer staple segment that I wanted to include it here. And honestly, shares have been slammed for the better part of 2 years, down 65% since January 2018, but are starting to show some signs of a turnaround. Sales and cash flow have recently improved, and the company is in that discount space of retail, so much more protected against that death by Amazon that we see in those other retail stores. Shares are trading for just 5.4 times earnings, and even with that 5.8% drop in earnings expected over the next year, Big Lots is still just 5.7 times earnings. This company is paying just 30% of its profits out to support that 5.6% dividend yield. It's a small company though, just $840 million in market cap, and is trading cheap on just about every metric. Analysts have a low target around $25 and a high of $32 per share, which is 48% over the current price. Now, like Kraft Heinz, this one could still be volatile and might take a year to realize that turnaround, so you might consider using that covered call strategy that we talked about recently. That's an option strategy I use to produce immediate cash return and get near-term protection on some of my stocks that I invest in. I'll leave a link to the video in the description below, so make sure you check that out. Our cash flow machine here is Altria Group, ticker MO, with a 7.2% dividend yield. Now, shares of Altria have been under pressure for the last couple of years on that disappointment over its e-cigarette acquisition Juul, but the assets have been written down lately, and it could be ready to trade on a more stable footing. After that 2008 split, Altria is solely focused on the U.S. cigarette and smokeless market, which means it's much less at risk to that volatile international market. Now, while tobacco use is in decline in the US, it's a very slow rate, less than a few percent a year, and pricing power keeps sales fairly stable here. One catalyst for the shares, besides that valuation, which we'll get to later, is its 10% ownership in Anheuser-Busch, which gives it a little bit of growth into that global beverages market. Shares trade for 11.3 times earnings, which are expected higher by almost 5.8% over the next year. Now, this one has fallen well past that point of value and has traded consistently around 13 times earnings, which could put it at $57 a share over the next year. In fact, analysts have the shares around $44 on the low end and up to $68 per share at the high end. Click on the video to the right for the 5 oil stocks that should be on every investor's radar in 2020. Dividend yields as high as 10% and upside price appreciation. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.